There is a $20 secret that the financial establishment is terrified you will discover. It is a glitch in the matrix of global finance, a discrepancy so large and so persistent that it mathematically proves the price of silver you see on your screen is effectively a hallucination. You're not talking about a minor arbitrage opportunity or a temporary market fluctuation. We are witnessing the complete bifurcation of the global monetary system. Right now, as you listen to this, the physical reality of metal is violently tearing away from the paper illusions of Wall Street, and the data suggests we are standing on the precipice of the single greatest wealth transfer in the history of precious metals. To understand the magnitude of this event, you have to look east. The Shanghai silver market has just done something that, in a sane world, would be the headline of every financial newspaper on the planet. The difference in price between silver in Shanghai and silver on the COMEX in New York has exploded to over $20 per ounce. Let that sink in. In Shanghai, silver is trading hands at over $132. In New York, the supposed global benchmark is lagging behind, trapped in a paper prison at around $112. This is a record gap. It is a gap that screams one undeniable truth. The Western mechanism for price discovery is broken. The real price is no longer being set by algorithms in London. It is being forged by physical buyers in the East who are demanding delivery, not derivatives. But this pricing anomaly is just the smoke. The fire is burning in the vaults. If we look at the inventory data coming out of China, the story shifts from a financial curiosity to a supply chain emergency. China's silver vaults have not just declined, they have effectively imploded. We are looking at inventory levels that have plunged from 5,500 tons to a mere fraction of that amount. This is a drop exceeding 90%. The silver is gone. It has not moved to another vault. It has been consumed. It has been absorbed into the industrial bloodstream of an economy that is devouring metal for solar panels, electric vehicles, and advanced military applications. This creates a geopolitical choke point that most analysts are completely ignoring. China currently controls over 70% of the world's silver refining capacity. To put that in perspective, even at the height of its power in the 1970s, OPEC never controlled 70% of the oil market. Beijing now holds the keys to the global silver supply chain at the exact moment that demand is going vertical. We are walking into a monetary and industrial bottleneck, unlike anything in modern history, and the Western markets are sleepwalking into the trap. However, the most explosive catalyst isn't what is happening today, but what is scheduled to happen in April 2026. This is the cliffhanger that the mainstream media refuses to touch. India, one of the world's largest consumers of precious metals, is preparing to formally remonetize silver within its banking system. This is not speculation. This is a scheduled shift in banking framework overseen by the Reserve Bank of India. For the first time in a century, silver will re-enter the formal financial system as a recognized store of value and collateral for over 250 million people. Imagine 250 million people suddenly empowered to use their silver holdings not just as jewelry or heirlooms, but as banking collateral. This transforms silver from a passive commodity into active money. While Western technical analysts argue over resistance lines and debate whether silver is a Boris relic, the East is institutionalizing it as a foundational tier of their banking architecture. The irony is palpable. Western pundits declare silver is dead, while the East builds a new financial system on its back. The market is voting with tons, not tweets, and the vote is a landslide. This brings us to the inevitable collision. What happens when a paper market, which trades nearly 2 billion ounces of synthetic silver in a single day, collides with a physical market that has run out of metal? We saw a preview of this recently. For 6 consecutive days, the COMEX reported 0 physical deliveries. 0. The exchange that claims to set the global price could not move a single bar of metal for nearly a week. Meanwhile, the London markets played shell games with spreadsheets to mask the hollowness of their vaults. But when China reopened after their holiday, the reality check was instant. Prices in Shanghai ripped higher, dragging the global spot price with them like an anchor. This is the mechanics of a short squeeze on a planetary scale. The paper market relies on the assumption that nobody will ever ask for the real metal. It operates on confidence and inertia. But when the spread between the paper price and the physical price widens to $20, that confidence evaporates. Traders realize that the paper contract is a promise that cannot be kept. We are seeing reports of physical silver in India trading on the street for $170 an ounce. That is the real market. That is what people are actually paying. The screen price in New York is becoming a fiction, a legacy number that represents a world that no longer exists. The narrative you will hear from the establishment is predictable. They will tell you it is a bubble. They will tell you the top is in. They will try to scare you out of your position because they need your metal to cover their shorts, but the math does not support their narrative. When you have 1.8 billion ounces of paper silver traded in a day, an amount equal to over 2 years of global mining production, you are watching a simulation, not a market. These contracts are backed by nothing. They are settled by no one. And every time a physical bar leaves a vault in Shanghai or Mumbai, the simulation gets harder to maintain. There are research groups now projecting price targets for 2026 in the range of $550 to $750 to $750 per ounce. To the uninitiated, these numbers sound like insanity. But when you strip away the paper manipulation and look at the raw supply-demand dynamics, the logic holds. If the synthetic supply of paper silver is washed away by a delivery crisis, the price must adjust to the level where physical holders are willing to sell. If you are holding real metal in the world running out of it, you aren't going to sell for $30. You aren't going to sell for $50. The repricing will be violent because the suppression has been so prolonged. The smart money is already positioning for this. If we look at the behavior of top-tier mining companies, we see a distinct change in strategy. Executives are intentionally under-promising on guidance. They are holding back production optimization. They are preparing for listings on major U.S. exchanges to coincide exactly with the April 2026 timeline. These are the insiders. They see the order books. They know the refining bottlenecks. They are not acting like an industry in decline. They are acting like an industry preparing for a tidal wave of capital. They are positioning to catch the liquidity that will flood the sector when the paper dam finally breaks. We must also consider the macro environment. This silver squeeze is not happening in a vacuum. It is happening against a backdrop of global currency debasement. Sovereign debt is exploding. Interest payments on U.S. debt are becoming mathematically unsustainable. The only tool central banks have left is to print more currency. This is the debasement trade. Investors are fleeing fiat currency for assets that cannot be printed. Silver is unique because it is both a monetary metal and an industrial necessity. It is being squeezed from both sides. Investors want it to protect their wealth, and industry needs it to build the future. So, where does this leave the individual investor? We are in a transition period. The old system, dominated by London and New York, is losing its grip. The new system, driven by Shanghai and Mumbai, is asserting control. This transition will not be smooth. There will be volatility that tests your conviction. The paper markets will lash out, attempting to smash the price down to trigger stop losses and shake out the weak hands. But these are the death throes of a dying paradigm. As long as the physical metal continues to flow east, the floor price will keep rising. The danger lies in complacency. The danger lies in believing that the COMEX price is the real price. If a delivery failure occurs, if a major exchange or ETF admits they cannot source the metal to meet redemptions, the market will go no bid on paper and no offer on physical. In that scenario, the price on the screen becomes irrelevant because you cannot buy metal at that price. The only price that matters is what you can actually transact at. And history suggests that number will be multiples of what we see today. The age of paper promises is ending. The world is rediscovering the immutable truth that money must be finite, tangible, and free from counterparty risk. Silver is at the epicenter of this rediscovery. It is being hoarded by nations, remonetized by banking systems, and consumed by technology. The divergence between the paper narrative and the physical reality has never been wider. This is not a time to gamble. It is a time to position yourself on the side of reality. The paper game is ending. The physical game has just begun. The only question left is whether you will be holding the asset or holding the empty promise.